Did you know that in the last 90 days, the US Mint has been rationing gold Eagle coins to dealers for the first time since 2008? While you've been watching the stock market celebration, the smart money has been quietly positioning themselves in the one asset that has survived every currency collapse in human history. But here's the kicker. 90% of Americans buying gold today are making catastrophic mistakes that could cost them everything when the system finally breaks. While financial media celebrates another soft landing narrative, the receipts tell a different story. The Federal Reserve's balance sheet still sits at $7.4 trillion. That's 700% higher than pre-2008 levels. Meanwhile, global central bank gold purchases hit a 55-year high in 2023, with China alone adding 225 tons to their reserves. These aren't the actions of institutions confident in paper currency stability. The mainstream lie is simple. Gold is a barbarous relic that doesn't generate income. But the receipts show something entirely different. Since 2000, gold has outperformed the S&P 500 by 180% when you account for real inflation. More importantly, it's done this while providing the one thing stocks can never offer: counterparty risk elimination. But here's where most people get trapped. They assume all gold investments are created equal. They're not. The difference between owning physical gold coins, bars, and ETFs isn't just about storage convenience, it's about whether you actually own anything at all. When the financial system experiences its next stress test, let's break this down using what I call the four-stage gold framework, a pattern that's repeated itself throughout monetary history and is setting up to repeat again in 2026. Stage 1, the delusion phase. This is where we are right now. Paper gold products like ETFs trade at artificial discounts to physical metal. The Spider Gold Trust, ticker GLD, currently holds 879 tons of gold, or so they claim. But here's the receipt that should terrify you. GLD's prospectus explicitly states that in a crisis, they may suspend redemptions and settle in cash at their discretion. You think you own gold, but you own a promise that can evaporate overnight. Stage 2, the awakening phase. Smart money starts demanding physical delivery. We saw this pattern in March 2020, when gold futures traded at a $70 premium to spot prices because no one could get actual metal. Dealers ran out of inventory, premiums exploded, and delivery times stretched to 12 weeks. The paper gold market nearly collapsed under the weight of actual demand. Stage 3, the rush phase. Public awareness hits critical mass. This happened in 1979, when gold went from $200 to $850 in 18 months. Coin shops emptied, refineries couldn't keep up with demand, and premiums on physical gold reached 40% above spot prices. If you didn't already own physical metal, you were locked out of the market at any reasonable price. Stage 4, the reset phase. Currency confidence collapses, and only physical metal maintains purchasing power. We've seen this pattern in Weimar Germany, Zimbabwe, Venezuela, and Turkey. Paper gold certificates became worthless overnight, but an ounce of physical gold still bought the same amount of goods it always had. Now, let's examine your options through this framework, starting with the most misunderstood category, gold ETFs. Gold ETFs like GLD, IAU, and SGOL have attracted over $200 billion in investor funds by promising easy gold exposure without storage hassles. But here's the receipt that fund managers don't want you to see. None of these ETFs guarantee you can redeem shares for actual gold. GLD requires a minimum 100,000 share redemption, that's roughly $20 million at current prices, and even then, you get whatever gold bars they choose to give you, not necessarily investment-grade deliverable bars. The authorized participant structure creates another layer of counterparty risk. When you buy GLD shares, you're not buying gold, you're buying shares in a trust that holds gold. If the authorized participants face liquidity problems, like they did in March 2020, the ETF can trade at massive discounts or premiums to the underlying metal. During the 2008 crisis, some gold ETFs traded 15% below their net asset value for weeks. But here's the most dangerous receipt of all. ETF gold isn't allocated to you personally. It's pooled storage, meaning if the custodian faces bankruptcy or legal challenges, your gold could be frozen in legal proceedings for years. This happened to MF Global clients in 2011. Customer assets that were supposedly segregated got trapped in bankruptcy court for over 2 years. Now let's examine gold bars, the choice of serious institutional investors and ultra-high net worth individuals. Gold bars offer the lowest premiums over spot price, typically 1 to 3% for larger bars like the 400-ounce London Good Delivery bars that central banks trade. But here's where the receipts get interesting. Not all gold bars provide the same liquidity when you need to sell. The gold bar market operates on a strict hierarchy. London Good Delivery bars, refined by accredited refineries like PAMP, Valcambi, or Credit Suisse, trade at tight bid-ask spreads globally. These bars come with assay certificates and serial numbers that make them instantly recognizable to dealers worldwide. But step outside this system and your liquidity evaporates. Smaller bars like 1-ounce or 10-ounce bars carry higher premiums, typically 4 to 8% over spot, but offer more flexible liquidity. You can sell part of your position without breaking up a larger bar. However, they're also more susceptible to counterfeiting, which brings us to a critical receipt: the rise in sophisticated fake gold bars. In 2019, JP Morgan discovered fake gold bars in their vault with genuine serial numbers and certificates. These bars passed initial testing because they were gold-plated tungsten with nearly identical density to pure gold. The counterfeiting has become so sophisticated that many dealers now require expensive XRF testing or even destructive assays before purchasing bars from non-institutional sources. This is where gold coins enter the equation and why they're becoming the preferred choice for serious precious metals investors. Gold coins offer something that bars and ETFs cannot: instant global recognition and standardized purity. The American Gold Eagle, Canadian Maple Leaf, South African Krugerrand, and Austrian Philharmonic are recognized by dealers, banks, and investors worldwide. These coins carry government backing for weight and purity, eliminating the counterfeiting concerns that plague the bar market. But here's a receipt that most coin buyers miss. Not all gold coins are created equal in terms of liquidity and recognition. The American Gold Eagle, despite being only 91.67% pure gold, the rest is copper and silver for durability, commands the highest premiums and best liquidity in North American markets. During the March 2020 crisis, when gold premiums exploded, Eagles maintained their premium spread better than any other coin. Dealers were paying 8 to 12% over spot for Eagles, while offering only 2 to 4% over spot for lesser-known coins. Canadian Maple Leafs at 99.99% purity offer slightly lower premiums than Eagles, but provide better value for pure gold content. However, their soft pure gold construction makes them more susceptible to damage, which can hurt resale value. The Royal Canadian Mint has tried to address this with their new Mint Shield technology, but older maple leafs without this protection show noticeable milk spotting that reduces their premium. Here's where the historical mirror becomes crucial. In 1933, when FDR banned private gold ownership through Executive Order 6102, gold coins were specifically exempted if they had numismatic value. While modern bullion coins wouldn't qualify under this exemption, the precedent shows how coin ownership has historically received different treatment than bar ownership. More importantly, coins offer divisibility that bars cannot match. During hyperinflation in Weimar Germany, people didn't need 400-ounce gold bars, they needed small denominations for daily transactions. Gold coins provided this flexibility, maintaining their purchasing power while paper marks became worthless. Now let's examine the storage question. Because owning gold you can't access is worthless. Home storage seems appealing, but carries enormous risks that most people underestimate. Home burglaries targeting precious metals have increased 340% since 2020, according to insurance industry data. Professional thieves know that gold owners often store their metals in predictable locations: safety deposit boxes at home, garage safes, or bedroom closets. More dangerously, homeowners' insurance policies typically cap precious metals coverage at $1,000, $2,500, unless you purchase specific riders that can cost 2 to 4% annually. That means your $100,000 gold position might only be insured for $2,500 if stolen. Professional storage through companies like Delaware Depository, Brinks, or International Depository Services offers allocated storage starting around $100 to $200 annually per $25,000 stored. Your gold is specifically earmarked with serial numbers, segregated from other customers' holdings, and fully insured. Most importantly, you maintain legal title. These companies cannot lend out or hypothecate your metals. But here's a receipt that reveals the storage industry's dirty secret. Not all allocated storage is actually allocated. Pool allocated storage, offered by some dealers and banks, gives you a percentage ownership in a larger pool of gold rather than specific bars or coins. This reduces storage costs, but reintroduces counterparty risk. If the storage company faces financial difficulties, your percentage claim might not translate to actual metal possession. True segregated storage, where your specific bars or coins are identified and separated, costs more, but eliminates this risk. The difference in annual fees might be $300 $500, but that's insignificant compared to the risk of losing everything to pooled storage complications. Here's where 2026 becomes critical. Three converging factors are creating the perfect storm for gold demand that could overwhelm existing supply chains. First, central bank digital currencies are accelerating globally. The Federal Reserve's FedNow system launched in 23, while China's digital yuan has processed over $14 billion in transactions. These systems give governments unprecedented ability to monitor, freeze, or confiscate digital wealth instantly. Physical gold becomes the only truly private store of value. Second, the derivatives market is creating artificial gold supply that cannot be sustained. The COMEX gold futures market trades 25 times more paper gold than actual physical gold in their vaults. This leverage ratio has increased 40% since 2020, indicating growing stress in the physical delivery system. Third, mine production is declining while demand accelerates. Global gold mine production peaked in 2018 and has declined 8% since then, due to ore-grade depletion and environmental restrictions. Meanwhile, central bank purchases hit 1,136 tons in 2022, the highest level since 1967. So here's your action plan for 2026. Calculate your current paper asset exposure. If more than 10% of your wealth depends on the banking system's stability, you're overexposed. This includes savings accounts, CDs, bonds, and yes, gold ETFs. For positions under $25,000, focus on coins, specifically American Eagles or Canadian Maple Leafs. Buy from established dealers like APEMEX, JM Bullion, or local coin shops with 20-plus year track records. Expect to pay 6 to 8% premiums over spot prices, but remember that these premiums compress during crisis periods. For positions over $25,000, consider a mixed approach: 60% coins for liquidity and divisibility, 40% bars for cost efficiency. Use segregated storage unless you have professional-grade home security and specific precious metals insurance coverage. Avoid pool-allocated storage, avoid all ETFs, and avoid any dealer offering prices significantly below market premiums. They're either selling fake products or operating Ponzi-style schemes that will collapse when demand surges. Most importantly, understand that gold isn't an investment, it's insurance against monetary system failure. You buy gold hoping you'll never need it, but knowing that when paper promises fail, physical metal preserves wealth across generations. The pattern is clear, the receipts are undeniable, and the window for preparation is closing rapidly. In every currency collapse throughout history, those who held physical gold survived the transition. Those who held paper promises did not. The choice is simple: be prepared or be prey. The transfer of wealth is coming. The only question is which side you'll be on when it arrives.